Leaving a job is a massive life change, but it's also this incredibly critical moment for your finances. So today, we're going to dive into a real-world case study about an investor who's facing a multi-million-dollar decision where just one wrong move could be, well, catastrophic. And it all boils down to this one number, 1.27. Now, on its own, it's just a number, right? But in the world of investing, a number like this can be a serious warning sign blinking in bright red letters. And for this one investor, this number is like a siren, signaling some hidden and honestly, potentially devastating risk buried inside their $2.7 million portfolio. So what is it? Let's unravel that mystery right now. All right, let's get right into it. The case study we're looking at is all about an investor who is standing at a major financial crossroads. So here's the deal. We're talking about a 38-year-old single investor. They've just left their job, and now they're trying to figure out how to manage a portfolio worth about $2.7 million, all without an active income. This is a huge transition point where the decisions you make can echo for decades. Okay, so where is this $2.7 million actually invested? This is where the story gets really interesting and risky. Let's pop the hood and take a look. Looking at the breakdown here, you can see the money is spread across a few different accounts. But the real alarm bell, it's screaming from that green slice, the Roth 401k. It has over $500,000 invested entirely in TQQQ. And for those of you who might not know, TQQ is a leveraged fund designed to deliver 3 times the daily return of the NASDAQ 100. It is an incredibly aggressive, high-octane bet. And that brings us right back to our mystery number, beta. Simply put, beta just measures how volatile your portfolio is compared to the overall market. A beta of 1.0 means you're basically moving in sync with the market. Well, our investor's beta is 1.27. That means their portfolio is 27% more volatile. I mean, that is a white-knuckle ride, especially when you're not working and you've got a loan against those very assets. Okay, so with all that going on, the investor reached out with a very specific question, one that a lot of people face when they leave a job. What in the world should I do with my old company 401k? You've probably heard this one before, right? It's the classic dilemma. On one side, if you keep the money in the 401k, you get these powerful legal protections from creditors. It's like a financial fortress. But on the other side, rolling it into an IRA gives you more flexibility and access. It seems like a straightforward choice, safety versus flexibility. But is it really that simple? Well, this is where the expert's advice just completely flips the script. The first strategy isn't about legal protection at all. It's about tackling a much more urgent and, frankly, more dangerous problem, liquidity. And there's this incredible saying that just nails the core issue here. Distant water can't save a nearby fire. See, our investor has what's called a pledged asset line. It's a loan using their investments as collateral. If the market tanks, the lender can hit them with a margin call, which forces them to sell assets at the absolute worst time to cover that loan. The money that's locked away in a separate 401k, that's the distant water. It just can't get there fast enough to put out the fire. So here's the bottom line. Rolling that 401k into an IRA at the same brokerage creates this vital safety net. It brings all the accounts together so you can make instant transfers to cover that loan if you have to. Plus, you can pull principal from a Roth IRA tax and penalty free after 5 years, which is another great escape hatch. For anyone using leverage, look, this isn't just a nice to have, it's an absolute necessity. Okay, so strategy 1 plugs the leak, right? It fixes the liquidity problem, but that's just treating a symptom. The expert's second strategy goes after the root cause of the fire itself, that dangerously high beta. And the goal here? It's super simple, super direct. Get that portfolio beta down from that crazy 1.27 to a much more stable 1.0. Bring its risk right in line with the overall market. This makes the whole portfolio way less prone to those wild swings. But, and this is the million-dollar question, right? How do you do that without getting slammed with a massive tax bill? And this is where the advice gets really slick. The plan is this 4-step tactical move. 1, sell some of the QQQ that's being used as collateral for the loan. 2, and this is the genius part, realize about $60,000 in long-term capital gains, which, for a single person, can be totally tax-free. 3, park that cash in a super stable money market fund. And that move directly achieves step 4. It de-risks the very assets that are securing the loan. I mean, this move into a money market fund, it's brilliant.
A fund like SWVXX is incredibly stable, which tames that wild beta. But, and this is crucial, it still has a high loanable value, so it's still excellent collateral for the loan. So you see, the investor gets to keep their borrowing power, but slashes the risk of that catastrophic margin call. It's the best of both worlds.
So, what can the rest of us learn from this whole situation? Let's zoom out and boil this all down into 3 powerful rules you can apply to your own portfolio.
Here are the big takeaways. First, liquidity is king. Always. Always remember that distant water can't save a nearby fire. Second, you have to actively manage your beta. You need to know your portfolio's risk number and make absolutely sure it aligns with your life and your goals. And third, be strategic about taxes. The tax code is a rule book. Use those rules to your advantage so you can make smart moves without giving it all back to the government.
And that leaves us with one last crucial question. I want you to really think about your own finances and ask yourself this one thing. When a crisis hits, is your portfolio's liquidity a well-designed feature, or is it a hidden, dangerous flaw?